Welcome to the deep dive from TalkTickers. We dig into earnings calls so you don't have to.
Today, we're unpacking the first quarter fiscal 2025 earnings call from Zumiez Inc. They're the action sports and lifestyle retailer.
Right. Our job here is to pull out the key numbers, the strategy, the outlook, basically, everything you need to know fast.
Yeah, we'll sift through it all, find the important bits on their performance and what they're looking at going forward.
Okay, let's get right into it. First quarter results, this is for the period ending May 4th, 2025. What are the big numbers?
All right, top line first. Net sales came in at $184.3 million.
And how does that compare?
That's up 3.9% from the same quarter last year. So some growth there.
Okay, 3.9%. And what about comparable sales? That's always a key one.
Yeah, comps were up 5.5% for the company overall.
5.5. That's pretty solid. And I think that continues a trend.
It does, yeah. It's actually their fourth consecutive quarter of positive comparable sales growth.
Okay, good momentum. Was that growth everywhere or more specific?
Mostly driven by North America, actually. Their North America comparable sales were up a strong 7.4%.
7.4. Wow.
And that's the fifth quarter in a row they've seen growth in North America. So the core market's doing well.
Clearly. What about the other parts of the business, Europe and Australia?
Right, their other international segment. That saw comparable sales down 2.3% for the quarter.
Okay, so a bit of a mixed picture geographically then.
Yeah.
North America strong, international weaker.
Exactly.
And inside the stores, what was selling? Any particular categories doing better?
They mentioned women's was the strongest category with positive comps.
Okay.
Followed by men's, footwear, and accessories. Those were all positive too.
So apparel and footwear doing all right. What wasn't?
The only category with negative comps was hard goods. So like skateboards, snowboards, that kind of stuff.
Got it. Now, that overall 5.5% comp growth, what was behind that? Was it more shoppers or were people just spending more?
It was mostly about people spending more when they did shop. The increase came from higher dollars per transaction.
How so? Like higher prices or buying more stuff?
Both, actually. They saw a higher average unit retail. So the price per item went up and they saw more units per transaction, meaning people bought more items each time.
Interesting. But did they say anything about the number of transactions?
Yeah, total transactions were actually down.
Right. So fewer people walking through the door or maybe fewer buying trips. But the ones who did buy spent more and bought more items.
That's the dynamic, yeah. The higher spend per visit more than offset the drop in traffic, essentially.
Okay, let's shift down to profit. How did gross profit look?
Gross profit was up 6.6%, reaching $55.3 million.
And the margin percentage, did that improve?
It did. Gross margin improved by 70 basis points compared to last year. It hit 30% of net sales.
30%. What helped that?
Mostly leveraging store occupancy costs. Because sales were higher, those fixed rent costs became a smaller percentage of the revenue.
Right. Makes sense. Sales leverage helps margins.
Okay.
What about operating expenses, SG&A?
SG&A expenses were $75.2 million, which is 40.8% of their sales.
And how does that compare to last year?
That's actually up slightly as a percentage of sales by about 20 basis points.
Okay. But I remember reading something about a one-off item hitting SG&A.
You got it. There was a pretty significant legal settlement in the quarter. It cost them $2.9 million.
Oh, okay. And how much did that impact the percentage?
That settlement alone added about 160 basis points to the SG&A rate.
Wow, okay, 1.6 percentage points just from that one thing. So if you take that out...
If you back that out, yeah, their underlying SG&A would have actually shown improvement or leverage.
How so?
Well, they managed to find savings elsewhere. They mentioned leverage on non-wage store costs like utilities and supplies. That saved 70 basis points. Corporate costs saved another 30 basis points, and things like wages and training leverage saved 40 BPs.
So underlying cost control was actually pretty decent then, it sounds like.
Yeah, the settlement really skewed the headline SG&A number.
Okay, crucial context. So we've got sales up, gross margin up, but SG&A pressured by that one-time item.
Yeah.
Where did that leave the operating profit or loss?
They ended up with an operating loss of $19.9 million for the quarter.
And as a percent of sales?
That's 10.8% of net sales. It's still a loss, but it was slightly better than the loss they had last year, which was $20.2 million or 11.3% of sales.
Okay, still losing money operationally in Q1, but moving slightly in the right direction, excluding that settlement impact. What about the final net loss?
Net loss was $14.3 million. That works out to 79 cents per share.
And they mentioned the settlement impact on EPS too.
They did. They said that legal settlement specifically cost them about 13 cents per share.
Right. So again, better than last year's Q1 loss of $16.8 million or 86 cents per share.
Correct. And just to round it out, the effective tax rate for the quarter was 9.1%.
Okay, so that's the Q1 picture. Sales growth led by North America and higher transaction values.
Yeah.
Better gross margins, and net loss, but improved year over year, though muddied a bit by that legal charge.
Pretty much sums it up. And management did point out that if you exclude that settlement, they actually beat the high end of their own guidance for both sales and profit.
Always good to beat guidance. What did they credit that to?
They highlighted strong full price selling, so not relying on heavy discounts, and they felt customers responded really well to their merchandise mix and the whole shopping experience.
And that ties into their bigger strategy, right? Let's talk about their strategic priorities. What's number one?
First priority is what they call accelerating top-line expansion and winning with consumers, basically driving sales growth.
Okay, how are they doing that?
A big piece is just constantly bringing in new products, keeping things fresh.
Newness is key in their space, I imagine.
Definitely. They mentioned launching over 115 new brands in 2023, and then another 120 plus just last year in 2024.
Wow, that's a lot of new brands hitting the shelves.
Yeah, and they said these newer brands are now a much bigger chunk of their total sales than they used to be.
Okay, so constantly rotating brands. What else for driving sales?
The other really big factor is their private label business.
Ah, their own brands. How big is that now?
It's gone quite significant. It expanded to nearly 30% of their total sales in Q1.
30%. Really? That feels high for a retailer known for carrying other action sports brands.
It is a big jump. It was 28% last year, 23% the year before that, and only 11% 5 years ago.
Huge growth.
Yeah.
Why the focus there?
Well, it gives them more control over design, over sourcing, and importantly, over margins. Plus, it offers customers different options, maybe at better price points. They see it as a key driver for profitable growth.
Makes sense. Control and profit. Anything else on the customer front?
They also talked about investing in service, both in stores and online, and using tech for more personalized connections.
Okay, so priority one, grow sales with new stuff, private label, and good service. What's priority two?
Priority two is all about profitability, especially keeping a disciplined focus there, particularly in North America.
And levers for that.
Again, that full price selling helps protect margins. And they've been working on operational efficiencies.
Like what?
Things they did last year mostly, like closing, I think it was 31 unprofitable stores in fiscal 24. They also optimized staffing in the remaining stores and found ways to cut costs in areas like shipping and logistics.
Got it. Tightening the belt, cutting less productive stores, and the third priority.
That's about using their financial strength. They want to leverage it for growth, but also to manage all the uncertainty out there.
And how strong is their financial position?
Pretty solid. They ended Q1 with $101 million in cash and marketable securities.
And debt.
No debt on the balance sheet, zero.
Always good to hear. No debt gives you flexibility. How are they using that strength?
Primarily returning cash to shareholders through buybacks. They bought back 1.8 million shares in Q1.
How much did that cost?
Totaled about $25.2 million. The average price was $13.82 per share. And that actually used up their previous buyback plan.
Ah, so they completed that authorization. Did they announce a new one?
They did, yeah. The board approved a new plan for up to $15 million more in buybacks running through June 2026.
Okay, so continuing to return cash. They see that as driving value.
Yes, long-term value. Although they did caution that in the short term, like for Q2, the buybacks actually hurt the earnings per share number a bit since any loss gets spread over fewer shares.
Right, that makes sense mathematically. Okay, so strong balance sheet, buybacks.
Yeah.
But it also mentioned navigating uncertainty.
Yeah.
What are the big challenges they're watching?
Yeah, they were clear about the macro environment getting more complex and also the whole global trade situation. Tariffs were a big discussion point.
Ah, tariffs.
Yeah.
Always lurking. How's that hitting Zumiez?
They're actively trying to get ahead of it by diversifying where they source products from, specifically moving away from China.
Okay, makes sense. How much do they get from China now and where they're trying to go?
They started this year, 2025, with about 50% of their product coming from China.
50%? Wow, that's high.
Yeah. Their goal is to get that down significantly, closer to 30% or maybe even lower by the end of this year.
But that's a really aggressive shift in just 1 year.
It is. And longer term, they said they don't want any single country to be more than 20% of their sourcing.
Okay, so major supply chain diversification underway.
Mm-hmm.
How do they handle the costs associated with the tariffs, or just the cost of moving production?
They're working with their brand partners, their suppliers, to find production options outside China. They're also looking at, potentially some selective price increases, maybe bundling products, using markdown strategically, basically a mix of things to try and offset those cost pressures.
Even with all that pressure and change,
Yeah.
what do they expect for product margins?
Interestingly, they still think they can achieve modest year-over-year growth in product margin.
Really? Despite the tariff noise?
Yeah. They seem confident that their mitigation strategies, plus maybe some other margin opportunities they already had, will allow for that slight improvement.
That's quite confident. Okay, let's pivot to how the current quarter, Q2, started. They gave some color on May sales, right?
They did. For the first 4 weeks of Q2, ending May 31st, total net sales were up just slightly, 0.7% compared to last May.
0.7. And comps for May?
Comps were up 1.4% for that period. So positive, but definitely a slowdown from the 5.5% in Q1.
Okay, 1.4%. How did that break down by region? Did North America hold up?
North America comps were still positive in May, up 5.1%, so continued strength there.
But that implies what happened internationally. It was already down in Q1.
Yeah, that's where the weakness really showed up in May. The other international segment, Europe and Australia, saw comps down a very steep 14.8%.
Whoa, nearly 15% down. That's a big drop.
Yeah, even excluding currency impacts, it was down 12.7%, so a significant slowdown from Q1's negative 2.3%.
Okay, so North America carrying the load again, but international took a nosedive in May. Any shifts in categories?
A bit of a mix-up there, too. Women stayed positive in May. Hard goods actually turned positive, which was different from Q1.
Okay.
But men's, footwear, and accessories all went negative in May.
And the driver for that small overall 1.4% comp, same story as Q1.
Pretty similar, yeah. It was driven by higher dollars per transaction, mostly from higher prices, average unit retail. Units per transaction were actually slightly down in May, unlike Q1. And again, total transactions were down.
Fewer people buying slightly fewer items, but paying more per item.
Mm-hmm.
Okay. Did management comment on that May weakness, especially internationally?
They acknowledged May came in below their own plans and, particularly highlighted the softness in Europe and Australia. They mentioned maybe some timing shifts played a role, but they definitely didn't hide the challenge there.
All right, so Q1 beat expectations ex-settlement, but May started Q2 on a softer note, especially overseas. Let's talk outlook then. What guidance did they give?
Well, first they stressed there's a lot of uncertainty right now, especially with tariffs making it hard to predict pricing and consumer spending.
Understandable. So for the second quarter, ending in early August.
They're forecasting total sales between $207 million and $214 million.
Which is how much change year over year?
That's basically flat, somewhere between down 2% and up 2% compared to Q2 last year.
Okay, flattish sales. And comparable sales guidance for Q2.
They expect comps between negative 1% and positive 3%. So a pretty wide range there, likely reflecting that May softness and the general uncertainty.
-1 to +3. And product margin, still expecting growth.
Yes, they still expect product margin to increase year over year in Q2.
But what about the operating line? Profit or loss in Q2?
They're guiding to another operating loss for Q2. They expect it to be between $0.7 million and $4 million.
Which is potentially wider than last year's Q2 loss.
Yeah, last year's Q2 operating loss was smaller, only $0.4 million. So the midpoint of their guidance is definitely for a larger loss this year.
And that translates to the bottom line, the loss per share.
Right. They expect a loss per share between 9 cents and 24 cents for Q2. Last year, the Q2 loss was just 4 cents per share.
Oof. So even with sales potentially flat to slightly up and margins improving, the loss is expected to widen in Q2. Why is that? What are the pressure points?
They flagged a few things. One is lower interest income, just because they have a bit less cash than they did a year ago, even though the balance is still strong.
Okay.
Another is a bigger expected loss from Europe, and that gets worse when translated back to dollars because of unfavorable currency exchange rates.
The FX impact. And that ties into the tax rate too, doesn't it?
Exactly. They expect a higher or more unfavorable effective tax rate in Q2. That's because more of the overall company loss is coming from Europe, where the tax benefit might be different or harder to realize than in North America.
Right. Tax complexities based on where the losses occur. And you mentioned the buyback impact earlier.
Yeah, the share buyback actually makes the loss per share look worse in Q2 because you're dividing that projected loss by fewer shares outstanding. It should help EPS for the full year as they turn profitable, but it works against you when you have a quarterly loss.
Gotcha. Okay, so several headwinds making the Q2 bottom line look tougher. What about the outlook for the whole year, fiscal 2025? Are they still feeling confident?
They admitted visibility is tougher now than it was back in March, mainly because of all the tariff talk announcements, suspensions, ongoing negotiations. It makes things foggy.
And they warned that if big tariffs do come back.
Yeah, they said significant tariff reinstatement beyond what's currently assumed could really hurt consumers and negatively impact their results. Big caveat there.
But assuming the current tariff situation holds, what's the vibe for the full year?
Under current conditions, they said achieving their previous annual expectations is still feasible.
Feasible. Okay. And what did those expectations look like? Sales growth.
Yes, they still believe they can grow total sales year over year for fiscal 2025.
Even though they're closing stores.
Right. They closed 33 stores last year, and they plan to close about 20 more this year. They estimate those closures alone will knock about $14.7 million off the top line. So growing sales despite that headwind is the goal.
Are they opening any new ones?
A few. Plans are for 9 new stores this year, 6 in North America, 2 in Europe, 1 in Australia. The 20 closures are mostly U.S., plus a couple in Canada and 1 in Europe.
Okay, net reduction in stores, but still aiming for sales growth. What about full-year margins and costs?
They expect modest year-over-year growth in product margin for the full year, building on last year's gains. They also see more gross margin leverage coming from occupancy, distribution, and logistics.
And SG&A, excluding that Q1 settlement.
They think they can keep SG&A costs relatively flat as a percentage of sales compared to last year. So controlling expenses while still making some strategic investments.
So if you put that all together, sales growth, margin improvements, cost control. What's the overall goal for profitability for the year?
The goal is definitely to get back to profitability for the full fiscal year 2025. They expect operating margins and net profit to increase year over year.
That'd be a significant turnaround from the loss last year. Any other full-year numbers? CapEx.
Capital expenditures are planned between $14 and $16 million, pretty similar to last year. Depreciation and amortization also roughly flat at around $22 million.
And the full-year tax rate, still that high number.
Yeah, they expect it to bounce around quarterly, but the full year estimate is still in that 50% to 60% range.
Wow, okay. And share count for the year?
They're projecting about 17.5 million diluted shares. But importantly, that number does not include any impact from future buybacks under that new $15 million plan. So the actual number could be lower if they execute buys.
Okay, got it. Now, shifting to the Q&A part of the call.
Yeah.
What were the analysts really digging into?
2 things really dominated: tariffs and the performance in Europe. No big surprises there.
What more did they say on tariffs?
Mostly reinforce what we've covered.
Yeah.
The plan to get China sourcing down from 50% to 30% or less this year, the long-term 20% target per country. They mentioned a $7 million benefit they got from pulling inventory forward last year to get ahead of potential tariffs. And just reiterated they're working with brands and using pricing or bundling to manage costs.
And crucially, they stuck to their guns on expecting modest product margin growth despite it all.
Yep, they confirmed that again in the Q&A.
Okay. And on Europe, obviously those May numbers were rough.
Yeah, they acknowledged it's tough over there. They repeated their strategy isn't about aggressive growth right now. It's more about focusing on profitability and cash flow. That's why they slowed down store openings there.
So how are they trying to fix it, or at least stabilize it?
Focus is on bringing in the right new products for that market, sticking to full price selling as much as possible, keeping costs tight, and managing inventory carefully. They did note inventory in Europe was down year over year in Q1, which is good.
Any sense of timing for improvement?
They basically said the European business is really back half weighted, especially Q4, for profitability. So the focus now is just setting things up for a better second half.
Okay, that makes sense. All right, that covers the core details. Let's move to our This Is Not Financial Advice segment.
Right. We've walked through the Zumiez quarter, strong North America, moving fast on sourcing and private label, but real headwinds in Europe, plus the whole tariff uncertainty. Still aiming for that full year profit, though.
So considering that mix, the good, the bad, the uncertain, here's a thought experiment for you. This is purely speculative, not advice.
Go for it.
What about a pair trade? You go long Zumiez.
Okay.
Betting that their specific niche focus, their very strong North American core, the margin help from private label, the buybacks reducing share count, and especially their proactive, aggressive moves to diversify the supply chain. Betting all that makes them relatively resilient.
Okay, long Zumiez. What's the other state of the pair?
You simultaneously go short a basket of, say, international apparel retailers, maybe ones heavily exposed to those weak European markets we talked about, or ones whose supply chains are still really concentrated in places facing tariff risks, maybe less agile companies.
So the bet is on divergence. You're betting Zumiez' specific strengths. The U.S. focus, the sourcing shift, the niche appeal will help it outperform or be less bad than peers who are more exposed internationally or slower to adapt their supply chain.
Exactly. It's a play on relative performance, driven by geography and operational agility in this messy global environment. You're betting their specific model and actions provide a buffer others might not have.
It's definitely provocative, ties together the macro, the micro, the regional splits. It banks heavily on Zumiez executing that supply chain shift and North America staying strong.
Like we said, just a thought experiment based on the data points. Definitely not financial advice.
Absolutely. So let's quickly recap the main takeaways from our deep dive. Zumiez had a solid Q1, beating their own internal targets if you exclude that one-time legal charge. North America was the clear engine.
Yeah, and they're making real progress on key strategies. Private label is huge now, and they're moving incredibly fast to diversify sourcing away from China to handle tariff risks.
But on the flip side, Europe is a significant drag right now, and the May numbers showed that weakness intensifying. Plus, the whole tariff situation hangs over everything, creating a lot of uncertainty in their outlook.
Still, despite those challenges, the message was clear. They believe they have the levers, cost control, margin opportunities, North American strength to navigate this and get back to full-year profitability in 2025.
So as you listen to all this, what really jumps out at you? Is it how well the U.S. business is holding up? Is it the sheer speed of that sourcing diversification? Or is it the worry about how bad things might be in Europe?
Lots to chew on. And here's a final question to leave you with, building on that pair trade idea. Given Zumiez' focus on physical stores, curating unique products, and pushing their own brands, how well positioned are they really if consumer spending slows down more broadly? Can that niche model truly compete and stay profitable against huge online players or fast fashion giants in really tough times?
A critical question indeed. Is their model a strength or a vulnerability in the long run?
Something to ponder. That wraps up this deep dive from TalkTickers. Thanks for tuning in.
We'll catch you next time with another breakdown of the latest earnings calls.